Welcome to the daily update, where I'll go over the action in the market for Thursday, September 28th, and then we'll see how things look for Friday, September 29th. Have to turn on my laser pointer here. We are showing some improvement, but it looks like it's coming down to support, not only for the S&P, but in other indexes as well. And it's going to be, what is the market going to do with the PCE core, especially report that's going to come out on Friday? If it's stronger than expected, that could put a lot of pressure on the market. If it comes in at expected, all bets are kind of off. If it comes in weaker than expected, we might continue to see some more improvement. As we're going through this weak seasonal time, we're hopefully coming up to the end of it. This is the last trading day on Friday of the quarter. And so there'll be some maneuvering going on. There's a lot of money managers out there who will have to produce reports based on how things went this last quarter. And so that makes it kind of its own day in and of itself. But nonetheless, we did see some improvement in Thursday's session, but we're still negative overall. Right at the open, we had a slightly lower open, and we were above the daily pivot. So that was positive. And the daily pivot was at 42.68, and then prices then rose above the unchanged level. So we were able to go positive, and we got up to R1 at 42.98. Then we rose back above R1. We got above that level, but we didn't get up to R2 at 43.22. We didn't get back up to the August 2022 high at 43.25 before declining back down to R1, and then we closed just about at that level. We were up 0.59%, and volume was above average. Again, we're seeing some window dressing, a little maneuvering going on, so that's picking up some volume. And we may see that in Friday's session as well, because it's the end of the quarter. The technicals were negative. In the short term, we're still oversold. Our list is becoming shorter, but we're still looking extreme negative. We're somewhat extreme negative in the intermediate term. We're still okay in the longer term. It's about inflation, interest rates, and about the PCE report that's coming out, and then anything that the Fed might come out and say. Some comments. Oil and interest rates pulled back in Thursday's session, and that gave some relief to stocks. Microcaps are back above 100. We're keeping an eye on that. If they drop down and make a new 52-week low, that could be negative and kind of bleed through the market. We want to see microcaps and small caps doing well in a healthy environment. Here's our list for the short-term extreme negative readings. We have the CMB composite, the Stochh RSI, the CCI 20, the stochastics, and standard deviation chart. On an intermediate term basis, we've also lessened the list a bit, the PMO studies, as well as the shaken money flow as well. And that's a smart money indicator. We don't usually use it like an oscillator, so we're just trying to see if we can get some additional information from that. We're still dealing with the scenario that was developed a few weeks back, that the economy is stronger than expected and that the Fed will have to keep rates higher for longer. Okay, that's been ongoing. The variable is, are they going to have to raise interest rates? Is the economy so strong that the Fed can justify coming in and bumping up rates again? We're also keeping an eye on the Chinese economy, and then we're watching oil and interest rates because that's been putting a lot of pressure on stocks. The scenario that we're still dealing with, and this really hasn't been played out yet. It doesn't seem to be holding up so far. We didn't come down to that long-term trend line and then bounce up off of that. We're sitting right on it now, and I'll show you that. And then if we do continue to fall, we'll just become more oversold, even though we've worked off some of these conditions. And then we're also dealing with this weak seasonality. The dollar was up. It continues to go higher. If you want to do some traveling, we're seeing the euro coming down in relation to the dollar. It might be a good time to go to Europe. And interest rates also fell in Thursday's session. The 30 to the 5 is still back to normal, where the other yield curves that we follow are inverted. Sentiment is negative, where we did tick up. We had been at 25. We were getting to extreme negative. Well, we've bounced back up to 29, where we're just in the negative camp. And our trend is still negative. The ADX is still above its moving average. It's still above 20. That's a confirmed trend. I've changed our bias to positive with the up day. Actually, we've had 2 up days now. And our momentum, I'm keeping it mixed because we're still teetering right on some pretty heavy support levels. The reports that came out, we had weekly jobless claims lower than expected at 204,000. That can put some pressure on the markets. They had expected 215,000. Continuing claims came in at 1.670 million, and I have charts to show you of this. The third estimate for GDP, no surprise there, so it really didn't have much of an impact. It was unchanged at coming in at 2.1%, and that's what they had expected. The deflator, though, actually came in a little bit lower than expected, and this gave some support to the market. It was at 1.7%. They had expected it to be at 2%, which is what it was in the previous reports. Here's a chart showing the GDP and the deflator. The GDP is the blue line, where we're positive. Now, we would have to drop negative for 2 consecutive quarters for one of the definitions of being in a recession. And right now, it doesn't look like that's going to happen. And then the gold line is the deflator, and that's more inflationary, and that has also been decreasing. Personal consumption, it's declining as people are really feeling the crunch of what's going on economically, but we're still positive on a year-over-year basis. The net exports are flat right now. And we look at real GDP. Real means that it takes inflation into account, where it is going up over the previous quarter, at least so far. Then looking at pending home sales month over month, where they did decline when we look at this month versus a month ago, and they're also declining when we stretch this out to a year over year look as well. And there's a lot of problems going on in the real estate market. Prices are continuing to go up, as we saw this week, but sales are really going down. Interest rates are going up. And so at some point, there's going to be a tip, probably, that might even have more of a negative impact on the housing market. Looking at weekly jobless claims, where we did tick up just slightly to 204,000 from the previous week, but we're following mainly the blue line here. That's the 4-week simple moving average, and that continues to decline. That's showing that the labor market is tight. That's also justifying the Fed at least entertaining the idea of continuing to raise rates. Here's the continuing claims, where they did tick up this past week, but the moving average is continuing to decline. Then when we compare this all on one chart, we have the red line, which are initial claims, which are declining. We have continuing claims, the blue line, which is declining. And then we're about due next week to get the unemployment rate again, but that has been ticking up. Then we're also keeping an eye on the 10-year yield, where it closed at about 4.6%. I had to round that up. We're above that 4.02%, which is based on what RenMac has found here, that's when it really starts to have an impact on company earnings. Here's the intraday chart, where we did have kind of a flat to lower open. We did open up negative, but we were above the daily pivot, and then we were able to get above the unchanged level. We got up to R1. We got above R1, but never made it up to R2, nor to the August 2022 high. That's this dashed line up here, before falling back down, and we pretty much trailed along R1. We went above it, then a little bit below it, and closed pretty much right on it. Looking at growth versus value, where they're kind of mirroring each other right now. The blue line's a little bit above the red line. Growth outperformed slightly in Thursday's session. We also ended up being positive when we look at the growth to value ratio for the S&P, and we've been seeing that. You can see there's a bit of a trend coming in here, where we're seeing growth starting to outperform on an intraday basis, and that could be positive for the market. On an end-of-day basis, we're also seeing some improvement. We're not really breaking out of previous levels that we were at, but we are continuing to go up with recent prices. Keeping an eye on the VIX, where it has a tendency to go up when you look at the average from 1990 up to 2022, and that could be negative for stocks. Looking at the VIX with the up day, we did decline based on the line chart as well as the bar chart, and we're still below 20. And volatility is starting to drop back as well with the up day that we had. This fear gauge is continuing to go up, suggesting that fear is still prevalent in the market. And our other fear gauge is kind of going up just slightly right now, suggesting that there's some fear in the market. The VIX to VVIX ratio continues to go up. That is negative longer term. And we're ticking back down slightly with our 5-period simple moving average of the equity put call ratio. But we need to see this really turn and go down with some conviction behind it. It could easily turn and go back up. But the fact that it is coming down is positive. But on a longer term basis, we're still negative with the 253 period simple moving average of the equity put-call ratio continuing to go up. The Ulcer Index is also showing that there's more fear. Looking at our advanced decline line, we came right down to the moving average and bounced up off of that based on price. We turned up based on volume, but we're still below the moving average. We're still looking rather negative here. Even though we saw a decrease in new lows, we didn't see much of an expansion of new highs, and our 5 period and our 10 period continue to decline. So internally, we're not seeing an awful lot of strength, at least yet. Our advanced decline line ratio did tick up, but it's still negative. Accumulation distribution also showed a little bit of a tick up, but we're still below a declining moving average. And we're also still going down with the Chaikin money flow, wondering if we're getting to an extreme negative reading. We haven't been this low, at least for the duration of this chart. And so that may suggest that maybe we are getting to an oversold condition. The NYSE cumulative advanced decline line did show some improvement. We're coming back up to this trend line. We turned up just slightly, but we're still below the trend line with our other measurement. We saw a bit of a tick up with the ratio between risk on and risk off, but it's still headed down in the more intermediate term. Here's our trend. We're above 20 with the ADX above the moving average. The red line's on top, so we default to negative, but it is declining as we saw the green line going back up. We're also keeping an eye on the level where the red line is, because not very often we get up into this 40 area and then keep going after that. This could mark some kind of an oversold condition as well. And we're watching that same thing with the short-term ADX, getting close to this 40 level, even though we did decline, but this is a confirmed negative trend. The daily chart, we're right back to the trend line now. We were a little bit above it, then below it, then above it. Now we're right on it. The Stochk RSI is still extreme negative, but could start to come out of this oversold condition if we see follow-through buying. And the CCI 20 is also extreme negative. The other ones have fallen off the list, at least for now. The stochastics, we're starting to turn back up and no longer extreme in the short term, turning back up. It's still extreme negative in the intermediate short term. We're still declining in the long short term. The go, no-go system is still deep purple. That is negative. The TTM squeeze continues to fall, and we're watching to see, are we going to hit some kind of an extreme negative reading? Balance of power ticked up just slightly, but is still below the midpoint. That is negative. The bullish percent index, when we were going a little bit lower, we had some new, it's very hard to see, but we're continuing to decline with this indicator, and that's more negative, showing that there's not a lot of strength in the S&P currently. We're declining with the summation index based on price and volume, and the NYSE summation index based on price and volume, a broader measurement, that is also declining. We have switched back to neutral for the Elder Impulse system for the S&P. The mass index is not really doing much. The reason I have this is when this goes up to the blue line and then crosses back below the red dash line, that's a signal. And whatever the market's doing at that time, this indicator is predicting that there'll be a reversal. Well, while this was going up and generating a signal, that's when we were going down. But then for part of it, we were also going back up. And then right after that is when the signal was generated. And so that's why it's been really hard to put any confidence in this signal. We're showing a little bit of a tick up with our 200 period simple moving average of the S&P, and maybe we're bottoming out here with the 50 period moving average study as well. Now, it doesn't mean that we're going to necessarily automatically go up. We need a lot of other things to happen, but the fact that it's bottoming where it bottomed before could be taken as positive. But on a momentum basis, we're still negative. The PMO is declining. We're also declining based on price and volume. We're no longer extreme negative with the PMOs that are rising, but we are extreme negative with the buy signals, and we continue to decline with the PMOs that are above zero. We're declining and below 50 with the NYSE bullish percent index. We're also declining with the NASDAQ 100 bullish percent index. We're continuing to decline with the slope oscillator. This is our shortest term oscillator, and we're also wondering, is it getting to some kind of an extreme negative reading? The MACD also, is it getting extreme? It continues to be negative. And so all of our oscillators continue to be pointing down in the short, intermediate, and long term. Then looking at our moving average tree, and this is kind of strange. We're seeing the 200-day exponential moving average have a kind of a critical role right now. If we bottom here, and if this is acting as support and we continue to go up, usually it's the simple moving average that the market focuses on. Well, okay, we don't really know yet if this is going to keep going up from here, but as of right now, this moving average is providing some support. We're still in a pretty negative reading with our standard deviations chart. We're right on the border between a -2 and -3 standard deviation, meaning that we went down pretty far, pretty fast. And now, as we're going back up, it's working off some of this condition. We're still negative with the parabolic SAR. The Erin indicator continues to decline. Even though we saw the red line, which are sellers, that came down slightly, we're also seeing a decrease in buyers. And so our oscillator, since the red line's on top, we get a negative result and we're continuing to decline. On a short-term basis, we're still below this 100% retracement level, which had acted as support. If we try to go back up, as enough time passed so that this may act as overhead resistance now. And we're also wondering that same thing with the 61.8% retracement level. We're coming just a little bit underneath this level where it had provided some kind of loose support. We didn't quite get to this level, but are we going to have difficulty getting through that? It would turn things more positive if we could regain that level. And then longer term, we haven't come down to these two fib lines that are right on top of each other. If we do start to fall, we'll be watching this as potential support. And we're still just a little bit above 100 with the micro caps. Here's the trend line where we're just a little bit above it right now, depending on how you draw it out. I think we're kind of more or less right on top of it for the time being. And then this is an updated chart from David Keller, who thinks that maybe we're seeing a confirmed head and shoulders top with the S&P 500. Over here's the left shoulder, the head, the right shoulder, and then we broke down below that. That could be quite negative if the pattern ends up playing out that way. The Heiken Ashi is showing a little bit of an improvement, but it's still negative. We're also seeing a bit of an improvement with the Kegi, where the red line means it's negative, but now it's pointing up, and that's more of a positive slant. But when we look at the Renko, that's negative, and the three-line break continues to be negative. We're still below the 200-day moving average with the Dow. We need to get back above that if we're going to turn more positive. We've switched back to neutral for the diamonds, and we're also coming back up to this pivot level. We're wondering, is this previous support level going to hold for the NASDAQ 100? That, combined with the exponential moving average on the S&P, could be considered pretty critical support if these levels end up holding. And we switch back to neutral for the QQQs, and we're still above the 61.8% retracement level for the NASDAQ 100. This could be providing some support, even though we haven't quite reached that level. We're coming back up with the NASDAQ, which had a little bit more technical damage done right now. So we're just seeing a nice little bounce here, but anything too positive. And we're coming back above the 50% retracement level. We've danced below it. Now we're back above it. Instead of hitting one of these areas and then bouncing and going in the other direction, that's not what we're seeing right now. We're seeing a lot of indecisiveness. And we're also watching the FANG index, where we've come back down to test this previous low. We bounced up in Thursday's session. Is that going to end up providing some kind of support? The small caps have had a couple of good days back to back now, but they've got a lot of damage to repair. It looked like this pivot level has now been providing some support. Then when we look at the Russell 2000 index, we're coming off of an extreme negative reading with the RSI. We showed some improvement here with the price chart, but we're still below the 200-day moving average. The MACD is turning up, but it's still negative. With the small caps for the Elder Impulse system, we've had 2 days now where we switched back to neutral. The mid caps also below their 200-day moving average, came down just about to this pivot level, showing some improvement, but we need to see some follow through. And we're continuing to be neutral for the mid caps when measured by the Elder Impulse system. Also, turning back up slightly with the Dow, coming back up with the transports. The thing to point out is we're seeing some really solid weakness in the utilities, which could give some support to the S&P. And we're seeing the transports starting to show a little bit of an improvement with the S&P 500 ratio, but we need to see this really going up for that to turn more positive. The dollar continues to go up, and it wasn't up all that much, but overall it has been advancing. And here's the 10-year yield where we really spiked up and then came down and closed at the low for the session. And this is interesting because we've got this fear of a government shutdown, which could be happening here. And again, like I said, some people think, yay, let's do it. Maybe it'll cause some good change to happen. Other people are like, oh, no, we can't do that. We'll not live up to all of our obligations and the whole political posturing that goes on. But right now, when you take the 1 month yield and you subtract the 3 month yield, you have a shorter term yield and you subtract a longer term yield, you should always get a negative result. Right now, there is zero. And the other time that we saw this really dancing around was about the time the debt ceiling issue was hitting the market. Now that we're coming back up and seeing no real change, it might have some uncertainty going on with what's going to happen with the government and the shutdown. Then looking at the 30 to the 5 year, we're still above the zero line. So we've gone back to being normal with that. And we're just a little bit above the trend line when we go all the way back to 2009. Again, I'm not really looking at this as potential support. I'm looking at it as more of a long-term bias. If we're above the midpoint, that's more positive. If we drop below it, that's more negative. And then here's the arithmetic scale where we're coming down just to that trend line when we measure all the way back to 2009. This is kind of showing the same thing that we saw in the previous chart, but not as long-term in its view. And so far, this support seems to be holding. And then we take the 10-year yield. Okay, so you're looking at interest rates in the US, and then you subtract the 10-year yield in Germany. Okay, so that's getting a measure of interest rates, US to German. And then sometimes we see in the middle part that matches what the US dollar index is doing. Rates in the US have been going up. German rates have been going up. German rates were going up more than US rates. Now we're seeing them flip where US rates are going up more than German rates. And that is ending up matching the rise in the dollar. And the correlation between the two is getting kind of strong. Then the S&P to utilities ratio, where we're starting to spike back up now, which again could be positive, could be negative. When we see this going up, that often gives good support to the S&P. When it's going down, that can give good, or actually overhead resistance, or just real resistance, or okay, let me think of the right word to say here. It puts stocks under pressure. I love these take one videos. But we were really going up, and that we saw that as the market was going up. But then as we were chopping sideways, this ratio was still going up, but the market really wasn't doing much. Now that this is starting to go back up, that could be positive for stocks. And then looking at the Staples to S&P 500 ratio, that's continuing to fall, and that can also be positive for stocks. When this ratio goes down, you look at other times, that often marked a bottom or at least a continuation of an uptrend. Then we're keeping an eye on Tom Bowley's research. This will be the last time we look at this, where for the month of September, we tend to see weakness, and that's pretty much how things have played out. So our outlook for Friday, it's the last trading day of the third quarter, so there could be some weird things going on. Earnings reports will be coming out. I think Nike reported, and the UAW strike is still continuing. And then they're wondering, is there going to be a government shutdown? And then this, as I've been mentioning, the student loan repayments are going to be picking up again at the beginning of October, which could be a real drain on the economy. The technicals were still negative, and we do have a confirmed downtrend, but are we starting to see some improvement? One day isn't going to change everything. We need to see follow-through price action to the upside and have support hold for things to turn back more positive. We will be getting the advanced international trading goods as well as the advanced retail and wholesale inventories, not big influential reports. Personal income and spending, that's going to be big. PCE prices, the big one. And we're going to get the Chicago PMI, which sometimes can be influential, and consumer sentiment, which often is influential. And I'll have a chart to show you after that is reported. And then keeping an eye on all the different geopolitical events. Unless something really crazy happens, it's going to be about the PCE report that comes out in Friday's session, and then how the market reacts to that. Here's the updated calendar showing what's coming out in Friday's session. Looking at the Stock Traders Almanac statistics for September 29th, we're neutral to negative for the Dow and the NASDAQ, and we're just flat out negative with the S&P. So we don't have seasonality on the side of the market for Friday's session. We will be on the 20th and last trading day of the month, where sometimes we tend to see some weakness during a pre-election year. We also will be on the 29th, according to the calendar, where Carson has it going into the 30th. Well, that's a Saturday this time, but we do see some weakness at the end of September. We're also seeing this longer term look at the seasonality, where we really don't start to show things as looking more positive until the end of November into the beginning of December. Here's the NASDAQ, also with some late September weakness, the S&P with late September weakness, and we're only up 33.33% of the time in the month of September during pre-election years, going back to 1950. Our scenarios, we're leaning more towards the now down one because we have a confirmed trend, but are things starting to improve? We're not going with the up one yet. We're, other than some support holding, we don't really have much in the way of short to intermediate term positive indicators that we can latch onto right now. And we're not going with the sideways trend because both of our ADX indicators have suggested that we're in a trending environment. Our warning signs, the longer term trend signals, and I'll go over this in the weekly video, we're still below those levels. It's going to take quite a bit to break through them. We're in a seasonal and historical weak month and even a weaker period of the month. The equity put call ratio and the longer term equity put call ratio, they're both still going up. Even though the shorter term one is turning down slightly, we need to see more than just one day of that turning down. The risk on posture, even though it was up slightly in Thursday's session, it's still showing longer term weakness. Our S&P 500 oscillators are still negative, as well as the NASDAQ 100 PPO that we follow. The cumulative new highs, new lows for the NASDAQ are still showing weakness. The 3-month yield is still above where it was back in 2007. The S&P overall is underperforming utilities, and the Staples to S&P 500 ratio is advancing. Now, the chart that I showed you is an opposite of that. I showed you the S&P to Staples ratio, and when that's going up, that's positive. When that's going down, that's negative. This chart is a reverse of that. The Russell's still below its 200-day simple moving average, and we're wondering, did we hit a head and shoulders top? We're also wondering about that head and shoulders top that David Keller picked out for the S&P. The parabolic SAR is still negative, and the vortex is still negative. And Nike, I believe, came out with earnings. The positive signs, we have seasonality and setups that are still in the background that at some point will come back and kick into gear if we're going to get some later rally or later in the year rally that might help things out. The daily special K chart is still positive. We're still above a downtrend channel upper line. The Russell, the small caps, and the mid caps, they still have had recent golden crosses. Small and mid cap growth has been chopping sideways, but it's still in a longer term uptrend. The financial sector been getting hit hard lately, but still generated a recent golden cross. So our conclusion, we are negative. We do have a confirmed downtrend, but are we starting to see some signs of improvement? The trend in the short term is negative, but we're still dealing with an oversold condition and wondering, are things starting to look a little bit better? We can say that same thing in the intermediate term. We're not as oversold, but we'll have to see if we see some more follow through. Are things starting to look a little better? Long term, we still continue to be positive. So thank you. I hope you found this helpful. I hope you have a really good day. I will be preparing videos over the weekend, and I'll also have the daily video that I'll do for Monday's session. So have a great day, and I will talk to you in the next video.